Hey everyone, UiPath reported fiscal year 2024 third quarter earnings results, and I'm going to use that information and update my buy recommendation for UiPath stock. Coming into this quarterly update, I had UiPath stock rated on the borderline between a buy and a hold. I had been fluctuating the stock in that rating for the better part of the year, going up slightly and going down slightly, mostly because of valuation and a concern I had about revenue. So in this video, I'm going to update my recommendation for UiPath stock after reviewing the quarterly earnings update. So let's get right into those figures.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So UiPath delivered 326 million in revenue, which was a 24% year-over-year increase. Also, they reported annual recurring revenue of 1.378 billion in the quarter, which was a 24% year-over-year growth. Now, this revenue number was an acceleration from the previous quarter, which accelerated from the quarter before that, and that growth in the rate of growth, the second derivative of revenue, is the reason why many investors are enthusiastic again about UiPath stock. For a moment, investors were pessimistic about UiPath stock. Let me show you why that was the case. So what I have here is UiPath's quarterly results going back to April 2021. And this line here is the company's revenue growth rate. I want you to pay attention to this figure all the way down the line. So you could see UiPath was growing revenue at a healthy clip, 64% in April of 2021. And that rate of growth had been steadily decelerating. So between October of 2021 and January of 2023, the company had decreased its rate of growth from 49.9% all the way down to 6.5%. That was 5 straight quarters of decreasing revenue growth rate for UiPath. You can understand why investors were concerned. And the revenue growth rate of 6.5% was 10% of the rate of growth in April of 2021. So the company had slowed down its growth tremendously. However, as 2023 has played along, now this is UiPath fiscal year 2024. I know that can be confusing, but companies sometimes have fiscal years that are different from the calendar year. So UiPath's revenue growth has accelerated from 6.5% to 18.2% to 18.6%, and now finally in the most recent quarter, all the way up to 24%. So this reacceleration in the rate of growth has been really good news for UiPath and really good news for UiPath stock investors. In fact, after this quarterly update was released, in the day after the earnings were released, the stock price is up 25.5% on the day after the earnings announcement. Now, that's not all because of the growth in revenue, but that increase in the rate of revenue growth had a lot to do with why investors were pleased with UiPath's quarterly earnings report. UiPath also reported a dollar-based net retention rate of 121%. Dollar-based net retention measures how much an existing customer changed its spending with UiPath compared to the previous year. So a rate of 121% simply means that existing customers on average spent 21% more with UiPath this year than they were spending last year. And the reason why this is so important for me is because it demonstrates the value that UiPath is providing customers. It tells me about the customer value proposition. If customers are spending more money with UiPath every year, that tells me that UiPath is delivering good value in excess of what they're charging their clients. Because if they're not getting a good return on investment, then they won't increase their spending with UiPath. They'll look at the results and they'll say, you know what? We spent all this money with you and we don't think you provided enough value, so we're going to cut our contract with you. Right? And of course, that would be bad news for UiPath. But the opposite is happening. They're getting more spending from existing customers, which is a good sign to be sure. The CFO said that given the strength of our business model, we expect to balance growth and profitability while investing in the business to position UiPath for long-term success. That was encouraging to hear. More and more, these growth companies in 2023 are talking about balanced growth, not the growth at all costs that they were talking about in 2020 and 2021 when the cost of capital was near zero. So nowadays, investors are looking for companies to grow more responsibly, to grow more effectively, and not just looking for growth's sake. Additionally, UiPath is forecasting annual recurring revenue in the range of 1.45 billion for the next quarter, which would mean an increase from the previous quarter, which means that UiPath expects these good times to continue, the increasing revenue to continue. That was also a good sign for UiPath stock investors. UiPath also announced its newest platform, features that help customers gain real value by transforming millions of tasks and thousands of processes across the enterprise with AI and automation. That's really the core of UiPath's business. They help enterprises save money by automating tasks and incorporating AI to help automate tasks. That increases the speed to completion, it reduces mistakes, and it reduces the requirement for labor. You spend less money on labor. And given the rising cost of labor, this is becoming a better and better value for a lot of enterprises. The difficulty for UiPath is in the making their service cheaper, more accessible, so that companies, smaller size companies, can access their services and not be exclusively for those larger companies that can see gains from using UiPath services. So looking at the company's income statement, there's a few things to like and one thing I was a little bit concerned with. Let's look at the revenue growth, which came in at 325.9 million. That was up from 262 million in the same quarter the prior year. For the 9 months that ended October 31st, revenue increased to 902 million, up from 750 million. UiPath had done a good job keeping costs under control. Remember when I showed you those revenue decreases, the rates of revenue were decreasing? Management, noticing that decreasing rate of revenue growth, undertook some efficiency measures and got some costs under control, reduced some costs. But I noticed in the most recent quarter, costs in a few areas, namely in sales and marketing, ramped up again. Look here at sales and marketing of 191 million in spending. That was up from 156 million from the same quarter the prior year. A meaningful jump in sales and marketing, whereas general and admin expense are still down year over year, 56 million down from 63 million. But in the 9 months, if you look at it, sales and marketing are still down for the 9 months ended October 31st to 521 million, down from 527 million. Overall, the operating loss did improve. The company lost 55 million on the bottom line. That was better than the 66 million it lost in the same time the prior year. But the gain, the improvement in operating loss was smaller than it had been for the rest of 2023. So that was something that was a little bit concerning to me, that yes, the company accelerated revenue growth, but it came at the expense of a boost in spending in sales and marketing. And as I usually do, I give a check to the balance sheet, and UiPath has an excellent, pristine balance sheet with 2.4 billion in total current assets, nearly $2 billion in cash and marketable securities, with no long-term debt. So it's in a great position in terms of its balance sheet. So that's not a concern for UiPath stock investors. And finally, I'm going to highlight the company's strong improvement in cash flow from operations, which, in addition to the revenue growth acceleration, is, I think, the other thing that boosted UiPath stock price so significantly following the update. You can see the cash flow provided in operations increased to 153 million in the 9 months ended October 31st. Compare that to last year, where they lost 103 million in cash flow from operations. That means they needed to use their savings in order to operate the business, right? They decreased their cash in operating the business. That's not the case this year. Now the business is self-funding, self-sustaining. They don't need to dip into savings to operate the business. In fact, if they continue at this pace, every year they're going to be adding to their savings. They're going to be adding to their cash balance because the business is generating cash flow. That's great news. And that was the other reason why I think UiPath stock price was up so much. So finally, going back to my recommendation of UiPath stock, I had it on the borderline between a buy and a hold coming into the quarter. And looking at its valuation now after the big jump in the stock price, it's now trading at a price to free cash flow of 82, which is still a little bit too rich for me. The company's performance improved significantly, which is what I was looking for, but the stock price jumped following the performance improvement to compensate for that improvement. So we got the performance improvement, but the stock price also jumped to compensate for that, which leaves me in the same position I was in coming into the quarter, which I have it on the borderline between a hold and a buy. If I can get this stock at a better valuation, I would like that very much. It just seems expensive to me at a price to free cash flow of 82. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.